Something happened inside the global oil market in the past 2 years that was reported as an energy story, filed under commodity news, and largely forgotten by the financial press within a week of each occurrence. Taken individually, each event looked routine. Taken together, they constitute the most significant reorganization of the monetary foundations beneath global trade since 1971. OPEC Plus cut production in coordination with Russia at a moment when the United States explicitly asked them not to. Saudi Arabia completed its first oil sale settled in Chinese yuan. Iran, Venezuela, and Russia, three of the world's largest oil producers, collectively holding roughly 15% of global proven reserves, of the petroleum trade entirely outside the dollar system. And the Saudi Sovereign Wealth Fund, which manages over $700 billion in assets, has accelerated its diversification into assets denominated in currencies other than the dollar at a pace that has no precedent in its institutional history. None of these events were accidents. None of them were impulsive. They were deliberate, coordinated, and in several cases, years in the making. And together, they are delivering a warning to the dollar's structural position that is more consequential than any Federal Reserve meeting, any inflation print, or any Treasury yield movement that currently dominates financial media. Most people watching the dollar, watching gold, watching oil, are asking whether prices will go up or down from here. They are asking the wrong question. The correct question, the one that determines not just the next trade, but the architecture of wealth preservation for the next decade, is whether the system that has kept the dollar at the center of global energy trade for 50 years is undergoing a terminal structural challenge. I believe the answer is yes. And in the next 25 minutes, I am going to give you 3 specific reasons why. First, what OPEC's silent move actually represents. Not an energy decision, but a declaration of monetary sovereignty that the mainstream completely misread. Second, the precise mechanism by which the petrodollar system has sustained American power and American borrowing for half a century, and the specific fracture points where that mechanism is now breaking down in ways that cannot be repaired through diplomacy or interest rate management. Third, what a genuine global monetary reset looks like from the inside. Not the dramatic overnight collapse that dominates popular imagination, but the slow, sovereign, irreversible repositioning that is already underway, and the single asset class that has historically served as the bridge between one monetary order and the next. I have spent decades studying monetary transitions, not as theoretical exercises, but as historical events with identifiable patterns, identifiable participants, and identifiable consequences for those who understood them and those who did not. What we are inside right now has clear historical precedents. The details differ. The mechanism is the same. Stay with me because what follows will not appear on CNBC. It will not be summarized in a Federal Reserve press release. But it is the story that explains everything else. In October 2022, OPEC Plus announced production cuts of 2 million barrels per day, one of the largest coordinated reductions in the cartel's history. The Biden administration had spent months cultivating diplomatic relationships with Gulf producers specifically to prevent this outcome. The administration needed lower oil prices to fight domestic inflation and to limit the revenue Russia was generating to fund its war in Ukraine. The Saudis understood both of those needs. They cut anyway. The financial press covered this as a geopolitical embarrassment, a diplomatic setback, a temporary rupture in the American-Saudi relationship that could eventually be repaired with the right combination of security guarantees and arms agreements. That framing was not incorrect, but it was radically insufficient. Here is what matters. The Saudi decision to cut production against explicit American wishes was not primarily an energy decision. It was a statement about the terms under which the kingdom is willing to continue anchoring the petrodollar system, the arrangement formalized in the 1970s, by which Saudi Arabia prices oil in dollars, recycles its surplus wealth into American financial markets, and, in exchange, receives American security guarantees, and military hardware. For 50 years, that arrangement was the hidden skeleton of dollar primacy. The Saudis provided the demand for dollars that every oil-importing nation was compelled to generate. Those dollars flowed back into treasury bonds and American financial assets. American borrowing costs stayed low. American deficits remained politically sustainable. The dollar remained unchallenged as the world's primary reserve currency. The 2022 production cut was the kingdom's most visible signal yet that it is reassessing the terms of that arrangement. Not abandoning it yet, but reassessing it. And the subsequent yuan oil trade with China was the operational complement to that signal. It demonstrated that the alternative exists, that it is functional, and that Riyadh is willing to use it. This is the part most people miss. The significance of the yuan oil trade was not the transaction itself. It was the precedent. For decades, the idea that a major oil producer would price and settle a substantial transaction in anything other than dollars was treated as theoretical, politically inconceivable, given the security relationships that bound the Gulf states to the American orbit. The yuan trade proved it was not only conceivable, but executable. Once a precedent is established at that level, in that relationship, the political and institutional barriers to further transactions are permanently lower. Let me be precise. Saudi Arabia has not abandoned the dollar. The overwhelming majority of its oil trade remains dollar-denominated. What it has done is far more strategically significant than abandonment. It has established optionality. It has demonstrated to its own government and to every other oil producer watching that an alternative settlement pathway exists and functions. In the calculus of sovereign risk management, the establishment of that optionality is not a minor event. It is a structural change in the game. Now watch what happens next, because the mechanics of what follows are not widely understood. To grasp why OPEC's silent move matters so profoundly for the dollar, you need to understand what the petrodollar system actually does. Not just what it is, but the specific economic function it performs. When oil is priced in dollars, every nation that consumes oil must acquire dollars. This is not a preference. It is a structural necessity. Japan must buy dollars to buy oil. Germany must buy dollars. India, South Korea, Brazil, Indonesia, every major oil-importing economy on Earth generates structural, non-discretionary demand for the American currency simply by running an industrial economy that consumes energy. This creates what economists call the exorbitant privilege, the ability of the United States to run persistent trade deficits without experiencing the currency depreciation that would discipline any other nation's fiscal behavior. Because the world's demand for dollars is not driven by confidence in American economic management, but by the physical requirement to purchase oil. The second component is the recycling mechanism. Oil exporting nations, Saudi Arabia, the UAE, Kuwait, Qatar, and historically Russia and other OPEC producers, accumulate enormous dollar surpluses. They cannot consume all of that surplus domestically. They must park it somewhere. For 50 years, the primary destination was American financial markets. Treasury bonds, agency debt, dollar-denominated corporate bonds, and increasingly U.S. equity markets through sovereign wealth vehicles. This recycling flow is the structural subsidy that has allowed the United States to borrow at rates that do not fully reflect its debt load. If the United States had to attract purely market-driven buyers for its treasury bonds, buyers evaluating the creditworthiness of an entity with $30+ trillion in debt and no credible deficit reduction plan, the clearing yield would be substantially higher than it is. The recycled petrodollar flow suppresses that yield. It is, in effect, a permanent, hidden subsidy to American sovereign finance. Write this down. Every percentage point of yield suppression across $30 trillion in federal debt represents approximately $300 billion in annual interest savings. The petrodollar recycling mechanism is not a rounding error in American fiscal arithmetic. It is a structural pillar, and that pillar is cracking. Here is the fracture map. Russia, which was one of the major participants in petrodollar recycling before 2022, now conducts its energy trade almost entirely outside the dollar system. Its oil revenue flows into rubles, yuan, and bilateral clearing arrangements. The recycling of Russian energy surplus into dollar assets has stopped. not reduced, stopped. Iran has never meaningfully participated in petrodollar recycling due to decades of sanctions, but its energy trade is increasingly settled in arrangements with China, with Turkey, with various Asian counterparties that normalized non-dollar oil settlement. Venezuela, similarly outside the dollar system. And now Saudi Arabia has demonstrated that even the anchor of the petrodollar arrangement is not immovably committed to the old terms. The total share of global oil trade settled in non-dollar currencies has been rising, and while it remains a minority, the direction of the trend is unambiguous, and the participants in that trend are not marginal actors. They are among the world's most significant energy producers. Now, combine this with something else I have studied carefully, the behavior of the American fiscal position. The United States is currently spending more on interest payments than on defense. That is not a projection. It is the current arithmetic. The Congressional Budget Office projects that interest costs will be the fastest growing component of federal spending for the foreseeable future. In an environment where petrodollar recycling is weakening, where the structural subsidy to Treasury yields is declining, the interest cost problem becomes a spiral rather than a trend. Higher yields to attract reduced demand. Higher yields increase the deficit. A larger deficit requires more issuance. More issuance at reduced demand requires even higher yields. This is not a hypothetical scenario. It is the directional logic of the forces that are currently in motion. The Federal Reserve sits at the center of this dilemma with no clean resolution. It can fight inflation by keeping rates high, which accelerates the fiscal spiral. It can support the Treasury market by cutting rates or resuming asset purchases, which risks reigniting inflation and further damaging the credibility that sovereign holders need to see maintained. There is no policy setting that satisfies both requirements simultaneously. The institution is structurally trapped, not by incompetence, but by the arithmetic of a debt load that was never designed to coexist with a structural reduction in demand for its own obligations. Gold understands this. Gold has been expressing this understanding with its price for 2 years, and the institutional buyers behind that price movement are not confused about what they are doing. Before we go to the third thread, if this kind of structural analysis is exactly what you have been looking for, then the beneath the headlines, the long cycle underneath the daily noise. Subscribe now. This is the work this channel was built for, and there is more coming. The word reset carries an enormous amount of baggage in financial commentary. It has been used to describe everything from minor policy adjustments to apocalyptic currency collapses. I want to use it precisely. A global monetary reset in the historical sense is not an event. It is a process. It is the extended period during which the rules of the existing monetary order, the rules that determine which currency settles global trade, which institution manages the world's reserve asset, and which nation's fiscal behavior is disciplined or exempted by the market are negotiated not at a diplomatic conference, but through the accumulation of sovereign decisions made independently across dozens of institutions over a period of years or decades. Bretton Woods was not created at Bretton Woods. It was created at Bretton Woods, but its real creation happened over the decade that followed, as nation after nation chose to peg to the dollar, build their reserve portfolios around treasury bonds, and organize their trade relationships around dollar settlement. The conference codified what structural forces had already made inevitable. The end of Bretton Woods similarly did not happen on August 15, 1971, when Nixon closed the gold window. That was the announcement. The actual end, the progressive erosion of the dollar's gold redeemability as an operational reality, had been occurring for years as American balance of payments deficits accumulated, as European central banks quietly accumulated gold claims against the U.S. Treasury, as Charles de Gaulle sent French battleships to New York to collect gold in exchange for dollar reserves. Nixon's announcement was the formal recognition of a structural reality that the market had been pricing for years. We are inside a similar period now. not the announcement, the pricing, the sovereign accumulation that precedes the formal recognition of a changed reality. Here is what that looks like in practice. It looks like central banks buying gold at the highest pace in 50 years, not because gold is fashionable, but because they are quietly reducing exposure to the dollar system and need somewhere to park the resulting reserve capacity that is outside the system they are reducing exposure to. It looks like the BRICS nations convening summits specifically focused on alternative payment infrastructure, not because they have solved the reserve currency problem, but because they are investing seriously in the optionality. It looks like Saudi Arabia completing yuan oil trades, not because it has abandoned America, but because it is demonstrating to itself and to the market that it can. This is the part most people miss. A reset does not require a replacement. The dollar does not need to be displaced by the yuan or by a BRICS currency or by a gold-backed instrument for the reset to cause enormous disruption to dollar-centric asset holders. The dollar only needs to become less central, to lose its unchallengeable primacy, its structural monopoly on the functions of reserve currency, for the repricing to be significant. And the mechanism of that repricing is already operating. It operates every time a central bank buys gold instead of treasuries. It operates every time an oil barrel is settled in yuan. It operates every time a sovereign wealth fund diversifies away from dollar assets at the margin. Each individual decision is small. The accumulated direction is not. Let me be precise about gold's specific role in this process. Gold is not the replacement for the dollar system. It is the bridge asset. In every historical monetary transition, there has been a period during which the old order is visibly weakening, but the new order has not yet cohered. During that period, sovereign institutions that have decided to reduce exposure to the old system but cannot yet identify a reliable new system hold gold, not as an investment, as a neutral reserve asset, one that is accepted everywhere, controlled by no one, and whose value is not contingent on any political relationship remaining functional. That is precisely the function it is serving now. And the scale of central bank accumulation, over 1,000 tons in a single year at prices that represent a historically elevated valuation, tells you something about the urgency with which that sovereign calculation is being made. The reset is not coming. The reset has begun. The price of gold is its continuous real-time ledger. Let us bring these three threads into a single synthesis, because individually they each tell an important story, but together they tell the only story that matters for the decade ahead. OPEC's silent move, the production cut against American wishes, the yuan oil trade, the accelerating diversification of Gulf sovereign wealth, is not primarily an energy story. It is the visible surface of a sovereign reassessment of the petrodollar arrangement that has underwritten American monetary primacy for 50 years. That reassessment is rational. It is grounded in specific geopolitical developments that have permanently altered the calculus of dollar dependency, and it is not reversible through the policy tools currently available to Washington. The petrodollar recycling mechanism that has structurally suppressed American borrowing costs for decades is weakening. That weakening places the Federal Reserve in an impossible dilemma between inflation management and debt sustainability that no interest rate setting can cleanly resolve. The fiscal arithmetic that results from that dilemma, rising interest costs, rising deficits, rising supply of treasury obligations into declining structural demand, is directionally clear and is already beginning to manifest in yield behavior. And gold, accumulating in sovereign vaults across Asia, the Middle East, Eastern Europe, and Central Asia at a pace that has no precedent since the Bretton Woods era, is the asset class through which the most deliberate and longest horizon capital in the world is expressing its conclusion that the dollar system, while not collapsed, is no longer the unquestioned foundation it was. Gold is the bridge between the world that is ending and whatever comes next. What unites all three threads is a single underlying force, the slow but accelerating withdrawal of institutional trust from the architecture of dollar primacy. Not a panic, not a crisis in the conventional sense. A recalculation, made sovereign by sovereign year by year, in the quiet language of reserve portfolio construction. that the risks of remaining fully inside the dollar system now outweigh the costs of beginning to move outside it. That recalculation, once it passes a certain threshold of sovereign participation, becomes self-fulfilling. Each nation that diversifies away from dollars makes it marginally safer and easier for the next nation to do the same. The system that was self-reinforcing in one direction becomes self-reinforcing in the other. We have not yet reached that threshold, but the direction of movement is unambiguous, and the velocity has been accelerating. There is a particular kind of clarity that comes from studying these transitions at the historical scale, from watching not just what happened in 1971 or 1944 or 1931, but why and how and who was positioned on the right side of history's slowest and most consequential market movements. The clarity is this: the window during which preparation is possible is always longer than people fear and shorter than they assume. The forces now in motion are not going to resolve themselves in a quarter or a year. They are structural, they are sovereign, and they will take the time they take. But they are not reversible, they are not hypothetical. They are documented in the reserve portfolios of central banks, in the routing of energy trade, in the architectural decisions of sovereign wealth funds that manage capital across generations. The people who navigate what is coming, not perfectly, not prescient about every detail, but structurally aligned with the direction of the shift, will not be the ones who recognized it in the headline when it finally became undeniable. They will be the ones who saw the mechanism clearly, early enough, when the price of positioning had not yet been fully paid by the consensus. The dollar warning is not in tomorrow's headlines. It is in the reserves of the world's central banks, accumulated quietly, month by month, in a metal that has survived every currency in the history of human civilization. That metal does not care about press conferences. It does not respond to forward guidance. It has no political relationship that can be strained or severed. It has no yield to suppress and no duration to exploit. It is simply the form in which sovereign judgment, distilled over thousands of years of monetary experience, chooses to store what it cannot afford to lose. The silent move has been made. The reset has begun. And the only question that remains is whether you are watching it happen to you or positioning yourself within it.